welcome all of you to start with. And like I said, we are carrying out this exercise for the benefit of our readers mostly, and also to get an editorial direction. My colleague Kundan Kishore, who's the deputy editor of Outlook Money, is also here, and he's been working with the mutual funds and markets industry for a long time. And during the discussion, please free to give any stock recommendations if you have. If not, we can just talk about sectors. That is completely up to you guys. And we really hope that by the end of this discussion, we are able to thrash out at least 5 sectors that investors can consider and we can feature in the magazine. So just to give a short introduction, today we have the market expert Amrish Balika with us, Devina Mehra, chairperson, MD and founder, First Global, Sunil Singhania, founder, Abacus Asset Management LLP, and we have Mr. Dheeraj Agarwal, co-head of institutional equities and head of equity sales at Ambit Capital. So Mr. Sushant Bansali was supposed to join us, but he had some last minute changes, I suppose. So Mr. Dheeraj is here. Thank you so much, Mr. Dheeraj, for taking out that time. And thank you all of you for joining this platform with us. So we can start the discussion right away. So starting with Mr. Singhania, he's also, I think he's supposed to leave a bit early because he has a meeting. So right now, I think everybody is talking about the RBI rates. And one thing that we wanted to understand as a team is that what does this RBI rate pause, which has happened recently, mean for the banking sector as such? Because in the recent past also, the sector has been in the news. There has been the US banking crisis that has been around, and then the back-to-back rate hikes. So I mean, there is clearly a lot happening in this sector. So how do you see this sector, Mr. Singhania?
Thanks, Nidhi, and thanks for having me. So very clearly, I think post the record inflation we had, based on the high inflation, which was again based on the very high commodity prices post the Russia-Ukraine crisis, I think central banks all over the world resorted to very tight monetary policy. And as you rightly said, even in the US, we had a record 4.5 percentage point, 450 basis point increase financial year 23 for us. And I think RBI also followed suit. The only good thing about India has been that interest rates, though they have moved up by 125 basis points in percentage terms, they have been much lower compared to the Western world. And inflation also has been less sticky in India compared to the Western world, a function of obviously self-reliance on agri. And therefore, the prices of food, for example, have not moved up. And luckily for India, energy costs, particularly oil, has come off. And on the other energy cost, all in all, we are more or less self-sufficient. I think though the market was expecting the RBI to follow with a small 25 basis point hike, I think it's a very pragmatic step which the central bank has taken because, it was obviously leading to some stress coming in demand, particularly on the household sector, mortgages and other sectors. And I think it has been welcomed. But even before this, I think the markets had already started to factor in a slowing down of the rate hike cycle. And in fact, at least our view is that the second half of 23, globally, you'll start to see some rate cuts. So the yields were at 7.4%, had already fallen to 7.3 to 7.33 after the budget because the borrowing program came in much, or I would say slightly lower than what was expected. And then after this pause, yields have come down to 7.2%. We are already starting to see the interest rate sensitives, particularly banks and some other interest rate sensitives like auto and real estate responding positively to this pause. And let's see, hopefully, inflation, as I said, would no longer be the demon which it was over the last 1 year globally. And at least our view is second half, we should start to see some indications of rate cuts.
Okay. So, but what does it all mean for the banking sector in terms of opportunity for investors?
Banking sector has been the sector which is standing out in terms of earnings. I think even this quarter, the March quarter, I think the earnings growth for corporate India are going to be driven by banks. A combination of hardly any stress assets or non-performing assets because of the diligence which the banks have taken up over the last 4-5 years. The initial phase of rate increases, in fact, are beneficial to banks because your assets get repriced faster than the liability. And there was a view which was getting formed that March quarter numbers would be the peak in terms of the NIMs, net interest margin. However, with this pause, now at least the view is that these kind of NIMs which the banks are making might sustain as we move forward. The other thing is obviously if the interest rates don't get increased, or in fact we start to have a rate decline, the possibility of credit demand to that extent improves. And I think from both the credit demand side as well as the spread, I think this should be quite positive for the whole lending space, both banks as well as banking financial services.
So, sir, where do you see the opportunity, especially in private sector space, private sector banks or PSU bank? Because in last 1 year, we have seen that PSU banks have done quite well as compared to the private sector bank. So, where is the opportunity?
So, we had a scenario where public sector banks were trading at non-existence kind of valuations. They were trading at like 50 and 0.5 time book, largely because of the fear of NPS coming back. However, as the results started to come in, and particularly the last 6-8 quarter numbers, I think the efficiency in terms of spreads net of credit cost have been pretty decent, and quite a few public sector banks to that extent have done much better. Having said that, I would say that instead of focusing on public and private, I think we should focus on good franchisees. Because ultimately for the banks, deposits are the raw material. So even within public sector banks, we have 2 or 3 banks which have great brands and they're able to be comparable to the best private sector banks in terms of maintaining their CASA ratio. And even in private sector banks, you have some banks which are struggling because they don't have the necessary brand to attract the cheap deposits. So I think we should focus on banks which have great brands. An opportunity exists in both the segments. The good thing is on the PE basis, banks are still not very expensive, and this would include some of the larger private sector banks and obviously some large public sector banks also.
Sir, in fact, I would like to ask you about IT and cement because I was going through your portfolio and I think IT is there.
Oh, yeah, this is for me again? Okay.
Yes, sir. Yes, sir. That is for you.
See, IT is one sector where Indian companies are the best in the world. This is one sector where India is globally competitive. And, these, I would say, speed breakers keep on coming in where the outlook, particularly being a global sector, the outlook pertaining to the user segment, which is predominantly US, comes to some extent as a headwind. So, we had a great 2021. And obviously, there was overhiring, and now we have job losses in the US, particularly on the IT side. But as I said, this is one sector where India is globally competitive. Even going forward, we are not looking at, degrowth in the sector. In dollar terms, we might end up growing 6-7%, even in a challenging 23. But in rupee terms, I think good companies will still end up growing at 10 to 15% profits. And the correction has happened both in terms of time correction and in some cases even price correction. And now companies by and large are available at 15 to 20 PE. We would be in the camp of at least ensuring that we don't go underweight as far as IT is concerned. If the world revives, which is at least my view that the second half of 23, you would see the global economy also reviving. And all the headwinds will become tailwinds, including lower inflation, lower interest rates, China coming back on steam, and even growth in the global economy, which was looking like a recessionary kind of an environment coming back to some extent. I think there's a possibility that sentiments might change here. And one thing also we have to remember is that IT companies the profits are completely cash conversion. And most of the larger and well-run companies distribute almost everything they make. So in that respect also, I think it's a great sector to be at least invested.
Okay. So coming to you, Devina, next, we had the budget like 2 months ago. And so what is the sense that we got from the budget in terms of sector, in terms of, the government spending and the sectors that can benefit from that? For example, I think there was a whole lot of this talk about the infrastructure sector. So what do you think are the sectors that are emerging in relation to the budget speech, so to say, the government spending?
I don't think, the budget in particular has changed the trajectory for anything because, and it should not also on an ongoing basis. In fact, if you look at the 2 years after COVID started, almost entire GDP growth was coming out of government spending. But obviously that can't do the heavy lifting forever because then you have consequences on the fiscal side. So as the economy has come to a more stable state, government spending is actually going down as a percentage of GDP. So, that can't be really the engine. Yes, of course, I mean, there will be pockets like infrastructure where spending is happening. So you have to look at where that benefits. Though, I mean, that also, there is a lot of debt build up there. So, that to me is the concern on the infrastructure side, which doesn't show up in government debt as such, because that's at other levels. But so I don't think, we can look at the budget as being really the driver.
Okay.
So yeah. Sorry.
So where do you see the opportunities then in terms of sectors?
Okay. So if you look at, in fact, you asked Sunil this about the rates and all, but if I look at both US and India, the central banks are now looking at something else achieving inflation control, really speaking, because inflation has not if you look at the historical data, has not been tamed either in the US or in India. In India, whatever the headline numbers you saw inflation coming down a little was entirely out of food prices, especially vegetables. Vegetables in 1 month and then other food in the other month. So if you look at core inflation, which is excluding fuel and food, that has remained quite, that has not come down. US, again, you got the low hanging fruit, some goods, inflation came down, and shelter, which is housing, came down. But what is very significant for them, which is non-housing services, that is proving again sticky. So what the Fed said was that that we are looking at something else may be able to achieve what we were trying to achieve through monetary tightening, which is that if credit situation tightens because of the banking problems, then it achieves the same thing as an interest rate hike by the Fed. In India, I mean, my view is, even though RBI did not articulate it, that they have growth concerns, but given that in 9 months till date, manufacturing has shown near zero growth. I think it is 0.4%. And, it was negative in 2 quarters, and for 9 months, it is just 0.4%. And, you all know that figure that 80 crore Indians still need free food. So there are growth concerns. And I think that is the reason why RBI decided to pause, and our savior, so to say, can be crude, because crude prices are down nearly 35% from the peak. And I had tweeted yesterday that helps India on all counts, on growth, on inflation control, on current account deficit, which was getting to be worrisome. And it helps a lot of corporate India, because crude is not just crude. I mean, crude per se would, if it gets passed through, would only help the oil companies, but all downstream chemicals, also the prices come down. And that helps a whole lot of industries, from FMCG, chemicals, textiles, paints, tires, to some extent cement also. So that right. I think can, and then, companies can take a call on whether to help that improve margins or to pass it on and therefore boost demand, because demand has been a concern for a variety of industries. So I think that could be the next driver, so to say.
Okay.
So in that case, where do you see the opportunity, ma'am?
So the sectors that we like, actually one sector has not changed for the last year and a half. We've liked it since October 21, which is capital goods and industrial machinery. And that has been a great performer for us because stocks have gone up 2-3 times. We've even booked some profit. So we don't hold as much as we used to, but still relative to the index, that would be the biggest overweight still. One sector which I usually don't like, which is banking, which is like, I'm always a very skittish investor or a very wary investor in banks. And as the Silicon Valley episode showed you, that's the problem with banks. You don't know where the problems are hiding, where the negative surprises would come. And having been a banker, I know that all too well. So I'm a wary investor. So since we started up EMS in 2020, in 2020 and 21, we hardly had any exposure to banks, which was actually a risky move because that's the biggest weight in the index. But it proved to be correct because in 2020, banking was the only sector that was in the negative for that year, in that boom year. 2021, it went up, but only half as much as the market. I think market was up 22%, banking was up 11%, the bank Nifty. But middle of 2022, we changed our stance and we went to market weight on banks. And partly, of course, that no sector underperforms or outperforms forever. So you always have to keep a watch for that. And also fundamentally speaking, there were some positives that the NPA cycle was behind them, credit was growing. And also when interest rates go up, at the margin, it is positive for banks because it's very simple that on the loans, the interest rates are hiked immediately. I mean, people would have seen it in their mortgage rates. And whereas on the deposit side, they are hiked only slowly. So for some time, there is a expansion on the margins. Of course, in Indian banks, because of their large bond holdings, you have to take that into account. But we went to market weight middle of 2022, and with price movement, it would have become somewhat overweight. So that sector we continue to like. Where we have added in our last rebalance, this quarter's rebalance is still going on, was a few pharma names, a few auto components, and also we are now slightly overweight IT services software, that segment also. Okay. Which of course was, did very poorly in 2022, but we're liking it more now.
So coming to you, Mr. Palika, where do you see the opportunities? Like we've been talking about banking, IT, cement, and some of the other sectors that Ms. Vera mentioned.
In fact, I had found opportunity in PSU banking about 3 years back because that was one space what everyone was shunning. And we had the private sector banks doing extremely well, but most of these were available at a fraction of the earlier valuation. And clearly, there was a change happening in the sense they were clearly looking at reducing the NPAs. And then what we saw in the last 12 to 18 months was clearly the balance sheet had improved and the business has started improving. In fact, the credit growth was happening for these banks and they perform extremely well. But at the current levels, I feel that most of them are fully priced, whether we are talking of the PSU banks or the private sector banks. Although the performance should be excellent in this quarter, but then again, it's always an expectation versus delivery. And the expectation is decently high from the analysts as far as the banks are concerned. So I don't think there'll be some major surprises. Okay. So, there's no reason to sell off, but then I don't see a major reason to go out and start buying into banks at this point of time. Because, at least my portfolio stocks, some of the PSU banks have actually become 2x from the levels which you had bought. So I'll not really be buying fresh as such. But then let me tell you that, whatever is happening globally in the banking space clearly are not going to affect the Indian banks because there is no direct connection except for the sentimental effect which we had for a while. Right. And we have already seen that. And typically in a rate hike cycle, the NIMs, expand initially, but then they start flattening out. And I think we are in that phase where we should see them actually flattening out. And like I said, although we have seen an extremely good credit growth of close to 17% in the last 1 year, but with these higher rates, I think at least for the next quarter or two, I think we should see the credit growth slowing down, especially on the SME and the retail side. And clearly, just like what Sunil is expecting, I mean, I also expect that the rate cycle should start going down, possibly from the beginning of 24, from January, February 24. I think we should start the rate cycle going down. I think that's time again, possibly to start looking at banks again. So, like I said, maybe for the next a quarter or two, I would be a bit cautious, and possibly in case we see a correction in the banking space, I would start looking at buying into banks towards the end of this year.
So in that case, where do you see the opportunity? As you were rightly pointed out that you have you were very much clear that the PSU bank will do well. So
right.
Where do you see the opportunity for another in next 3 years?
In the various sectors, I mean, other than banking, you're saying?
Other than banking, sir.
Yeah.
Yes.
See, I mean, you look at the budgetary's, allocation for infra and railways. I mean, it's been a record, and it's multiple times possibly what the government was spending about 8 to 10 years back. So I think there's a huge opportunity there. And in addition to that, defense. I think that's one focus area, Make in India. I think that's clearly a focus area for the government. And we have seen these sectors performing to a decent extent, but I still see, at least in the foreseeable 2 to 3 years, we should start, we should see these sectors performing well. And because of the spend on these sectors, we normally see that there's a trickle-down effect, because, end of the day, the cash flows actually gets distributed across. Whether it's the material suppliers, services, equipment providers. So clearly, I see the auto sector, earth moving, infra and construction related sectors, railway equipment and rolling stock manufacturers, you name it. I think across these sectors, we should see decent growth in the foreseeable 2 to 3 years. And that's where I think one should be investing.
So would you like to suggest some names? I know EIA, Engineers India is your favorite.
Engineers India, I've been recommending for a while, but then it's just been a market performance to an extent underperform, but then it should perform over the next 2 to 3 years. But then, as far as auto is concerned, my picks here would be Mahindra & Mahindra, Maruti, Tata Motors to a certain extent. In earth moving, it's BML. Infra and construction sector is going to be L&T. Railways equipment, like a stock like Titagarh Wagon, although it's already moved up quite sharply, possibly one should wait for a correction to buy into it.
Right. So, Mr. Agarwal, we've talked about many sectors, and auto has also come up in a few conversations. What do you think about that sector, and what other sectors that you see promising?
So to start with, let me just try and give my view a little bit top down. So one thing is very clear, that this particular budget was a little bit of a game changer in terms of the capex drive of the government. So last few years, while the headline capex numbers in the government budget has been high, but if you actually add the below the line capex of the government itself, it was still middling at 10, 11, 12% kind of a growth. This year, it has gone up to almost like 30%. And even in an election year, the government has resisted the temptation of pumping up the revenue expenditure too much. So the REVEX hike in this particular budget was just 2%. So that sort of sets the tone to some extent as to what is happening in the economy. Both Amrish and Devina talked a lot about the whole capex revival and the focus on capital goods names. That's one side of the story. The other side is obviously banking, which has been discussed also here. Banking earnings have rebounded. There's no NPL issue out here. The quality and the health of the banking system is pretty good. In the near term, we'll probably see some amount of margin pressure coming in on the banking, because we've seen loan growth running at 500 to 700 basis points higher than the deposits growth for a while now. And time has finally come where banks will have to chase deposits a little bit and hike deposit rates to be able to garner those deposits. And that typically happens, as Sunil was pointing out earlier in the discussion, that when the rate cycle peaks out is when the margin pressure starts showing up, because during the rising rate cycle, you can reprice your assets a bit faster than you're repricing the deposits. So the conundrum in the market at this point of time, what I was trying to come to by giving these two examples is the sectors which are doing well either have a valuation glass ceiling. So for example, in capital goods, the sector which has done really well, if you look at some of the really high quality names within that sector, they're already trading at valuations which is like 20-30% higher than the historical averages. Or banking, another sector which is doing well. The challenge is that in the near term, at least, there'll be margin pressure going forward. So one has to divide, or at least the way I prefer it, would like to divide the market into two parts, which is near term. So let's say next 6 to 12 months. And because of these two reasons, I expect the market to be range bound. While some of these sectors get some of these movements or cross movements and some of these tailwinds get priced in. From a longer term point of view, we still think banking will be one of the top winner sectors. Once there's a little bit of margin pressure, things is digested over the course of next few quarters. Both linked to the capex drive of the government, health of the balance sheet on the banking system, and topping of the interest rate cycle. But all three factors put together would result in reasonably decent growth for banking once we cross over this hump of a little bit of margin pressure. Another sector that we are finding very constructive at this point is pharmaceuticals. It's underperformed now for almost 2 to 3 years. Last quarter was the first in, I think, about 7 or 8 quarters that the pharma sector earnings did not disappoint, and the earnings were not cut after the result. In fact, for US generic-facing pharmaceutical companies, the earnings came 5 to 8% ahead of estimates. Second interesting data point there is that the erosion in the US generic prices is now more in the region of 6 to 8%, which used to be 12 to 14 or 12 to 15% till a few quarters ago. And 6 to 8% kind of a deflation will continue to happen in US generics, and that is something Indian pharmaceutical companies can absorb by new product launches as well as productivity gains. Right. So that's one sector which has hugely underperformed in the last 2 or 3 years, sort of almost on an ignored spot for most investors. Is something that we like, very, very constructive.
So, sir, as you rightly pointed out about the pharma sector, there is another sector that is FMCG. That sector has also not done well in last couple of years. So what is your view on that?
So FMCG, I think short term, there is a good tailwind for FMCG sector. So FMCG could be the opposite of, let's say, banking. Over the next 6 to 12 months, FMCG is likely to do well. For almost 4 to 6 quarters, we used to say gross margin disappointment in FMCG quarter after quarter. So, for example, some of the largest FMCG players like Unilever, the gross margins fell anywhere between 500 basis points and 700 basis points. And in some cases, almost 900 to 1,000 basis points, largely because of rising input costs. A lot of those input cost factors have now reversed. So, for example, palm oil YOY is down 25%. And many of the other key ingredients for FMCG at this point of time is down between 20 to 35% on a YOY basis.
Correct.
The companies had taken a lot of price hikes. One would expect some of those price hikes to get reversed to pump up the volumes, but not all. Historically, we have seen whenever FMCG companies come out of a margin compression cycle, for some time they retain the previous price hikes to boost their margins back. So one key metric at a macro level that we watch very closely is WPI CPI spread. For almost like 12 to 15 months, the WPI was like 400 to 600 basis points higher than the CPI. But in the last 2 or 3 months, they're actually 300 basis points below CPI. And that is typically gives a huge amount of margin power and pricing power to FMCG. The last it happened was actually in 2013 to 14. Prior to that, for almost a year, WPI ran ahead of CPI and then it collapsed. And those 2 or 3 years post that were one of the best in terms of margin expansion for FMCG. So I don't know whether this cycle will be that long, but at least for the next 6 to 12 months, FMCG is likely to do well.
Okay. Sunil sir, I would like to ask you, what is your favorite now? Which sector?
Frankly, I think...
That is your all-time favorite sector, sir.
No, I'll give you a very honest perspective. One is the best company in a not so great sector will do very well. And the worst company in a very good sector will struggle. And we have seen that in FMCG, we have some companies like ITC and all, which have gone up 50% last 1 year, whereas the best companies, which would include the favorites over the last 4 or 5 years, have not done well. So I think it is also about being very clear about what to buy. Same has been the case in financials. There are so many companies which have done well. And Devina mentioned that 20 and 21 were not great for the banking index. But if you take out the top 3 banks, all the other banks did phenomenally well. I think the index got a little bit impacted because of the likes of HDFC Bank and Kotak Bank, which were not performing, not because they are not great franchises, but because they were priced beyond perfection. So I think it's not necessary that you buy anything in a particular sector and you will make returns. And I think that is what we are focusing on. The other thing is, I might mention to you some sector, but the world is so dynamic. By the time next year your issue comes in, you would find the portfolio very different. So, I don't want to get bogged down with saying sectors, but, sectors continue to be same. All of us have mentioned that because those are based on the views as of now. I still like banking. On a PE basis, the sector is still quite cheap. I continue to be quite optimistic on the IT sector. Pharma, I agree. I think after a long, period of no performance, both on fundamentals as well as stock, I think we are now looking at demand coming back because of restocking and generic pricing also coming back. And also, after a long time, you're getting very good companies available at sub 20 PE multiples. So, rather than buying some consumption stock at 40, 50, 70 PE with a slower or lower growth rate than a domestic pharma, I would prefer the domestic pharma. We are still quite constructive on anything to do with consumption, but value consumption. Again, by nature, myself and Abacus tends to be value conscious investors. But I think that is one space where demand is going to be constantly there. And after a long time, as Dheeraj mentioned, the headwinds of input costs being pretty high are now turning into tailwinds. And in some sectors, even the energy costs have started to, reduce quite significantly, which can again become tailwinds. So these would be a few of my top sectors. Okay. Maybe I'll have to just take your pardon. I am very sorry.
Yeah. Sure. No, thank you so much for taking out your time despite having another meeting. Thanks for participating.
Thank you, Sunil sir. Thank you.
Bye. So, so Mr. Singhania has given his picks kind of. So coming to Ms. Mehra, Mr. Baliga and Mr. Agarwal, what if we were to thrash out what is coming out broadly from the conversation is banking, of course, IT, pharma, FMCG.
In fact, there is one more sector which I think should perform well, at least in the foreseeable future. Mm-hmm. This did not perform well in the last 18 months, just like pharma. We had extremely good move. It is specialty chemicals. We had an extremely good move during the COVID time. And here, over the last 3 to 4 years, we have quite a few of the Indian specialty chemical companies which have actually become world leaders in their specific segment. And I think this China Plus One and Europe Plus One should actually play out extremely well for them going ahead. So this is one space where I've been investing in. Stocks, Deepak Nitrite, Navin Fluorine, Vinati Organics. I think these are a couple of them which I think one could be looking at. And just like Dheeraj and Sunil said, I think pharma is the other space where I have been investing and continue to hold on. But one space like FMCG, where again, I'm decently confident of the consumption story going ahead. But then the existing companies which are there, which have actually ruled the space for the last 3 or 4 decades, I think over the next 4 to 5 years, there could be a major change. And I think that change will come from Reliance Retail, which I think could be disrupting the whole segment. Because end of the day, FMCG sector, has been dependent on the distribution network, which each of these bigger brands were controlling decently well. But what we have seen in the last 2 to 3 years is quite a lot of this distribution network is getting disrupted. And we have seen Reliance, in fact, controlling a decent part of that right up to the grocery shops. So, the one who controls finally the self space, I think is a winner. And this is exactly what Reliance is trying to do, both through the unorganized your grocery shops as well as organized retail, where they are the largest. And they have been introducing their own brands, which I think they'll finally build up. They've been buying out old brands, remodeling that and bringing that back. So I think there could be a major disruption going ahead. So that's one space we watch out for. In fact, I'm bullish on FMCG space and the existing companies which have not done too well in the recent past. So I think the next 12 months window is there, 12 to 18 months window is there. Post that, there could be a disruption.
Okay.
So do you see that, the Reliance retail demerger is going to happen anytime soon?
That should happen sooner than later. I mean, we've already seen that with the Jio Finance. I think that's the beginning. Right. We could have two more, which could be retail as well as the telecom. I think that could happen over the next 18 months.
So I think Jio Finance also will be another financial disruptor.
Absolutely. I mean, what possibly Bajaj did when the PSU banks went off the radar way back in 2013-14, and then we saw the NPA issues come up. Right. I think Bajaj had a good run in that 8 to 9 years. And
right. From 2013 onwards, yes.
Yeah, exactly. I mean, that's the time they made the hay when the sun was shining, especially in that sector. But then right now I see Jio possibly disrupting this space clearly here because of the sort of data and the connectivity which they'll have. I think they could disrupt it for Bajaj.
Okay, so we are talking about sectors right now, in terms of what the market is, etc. But do you guys, and this is for all of you, anybody can take this question, is do you also think that there are some all-weather kind of sectors which, a retail, a very lay investor, who may not be able to do this kind of research that experts do, can bank on?
This is something I tell people all the time, that no theme runs forever. No geography, no asset class, no sector runs forever. Even if the business is a so-called steady business, it is not as if it always gives returns. In 2020, I did a whole half-an-hour show on this. At that time, FMCG was really the much-loved sector. And I said, because I always go by data. If you will go by data, there are long periods of time when these so-called steady companies do not perform. I mean, Hindustan Unilever right from 1999 to 2010 did nothing much at all. I mean, also on the business side, not just the stock. Bata gave 0 returns for 15 years. So Nestle, all these companies have long periods of not performing. And at that time, I had said that any company which otherwise fits the category but is not performing, you don't even talk about. So ITC was in that category. So when we started to go back into FMCG, the first company we bought was ITC. So but many of those are not really sector calls. So last year, for example, among our top performers would be ITC and Raymond, but neither was a sector call. You were earlier asking about sectors. I had spoken about, of course, banking and capital goods. Capital goods still remains number one for us. As I said, we added auto components, pharma, but a lot of other sectors, it is really a bottom-up thing. So you might end up being overweight something, but that is coming out of, like chemicals was spoken about recently. Now, last year, chemicals it was all over the place because there were certain chemicals where the prices were going up. So if the company was making that, it was like bonanza time for them. But there was another category of companies for whom it was an input, and therefore, their margins went for a toss. So that you have to look at. So unfortunately, there is nothing called an all-weather thing. And what people must also remember, which is that most of your returns come from asset allocation. So, I mean, we all look for the multi-bagger, but first you have to get your asset allocation right. And number two, I say, first of all, you have to know what your current asset allocation is, which surprisingly few people know. And I'm not just talking retail investors. I've had large family offices who have one impression. You have a global family office and they will think that we are mostly in global fixed income. And then when you actually do the numbers, you will find they're mostly in Indian real estate. So those kind of, there's complete disconnect between what people think and how their net worth is actually deployed. So so there are, unfortunately, the market doesn't make it that easy for you. That But one advice which I would like to give every single investor is that you are going to be wrong a whole lot of times. If the best investor or fund manager in the world is also wrong a whole lot of times. So the best advice is that when you are investing, tell yourself that I may be making a mistake. Because where most people go wrong is in refusing to admit a mistake. So like, for example, now we use an artificial intelligence and machine learning system. We call it a human plus machine system. So the first round is done by the machine, which is that you have a system which looks at hundreds of factors. You look at all companies on the same basis with no bias or noise. That will maybe give you 70, 75 stocks, out of which then you put the human expertise to choose maybe 50 or 55 out of that. So we say we have the human element on the investing side, but we actively do not have a human element on the risk management side, because it will always be a human tendency to say that this stock is different, this time is different, let's wait a while. So you have to be ruthless on the risk management side. So, for retail investors, also have stop loss, have risk management parameters, have discipline, and keep to it. That's the hardest part.
Right. So that's very, very useful for our readers, because ultimately Outlook Money sticks with the retail investors and what they can do. So Mr. Balika, you wanted to add something to that, and also Ms. Mehra was also talking about the whole investing strategy around sector investing, so to say. If you could speak about that.
No, I mean, like you're talking about the all-weather.
All-weather.
Yeah. Like, I mean, when you talk about the weather itself, there's no, there's no certainty. I mean, you could have a hailstorm in the middle of summer. Right. So similarly, like nowadays, I don't think there is anything called all-weather sectors. I mean, there's so much of churn happening in the global economies. So a good story today could in fact turn irrelevant in the next few years unless the company is fleet-footed and is able to adapt to the change. So looking at the two-wheeler space, again, I'm not too sure how many of the current leaders will remain leaders in the next 7 to 8 years, looking at the way the EVs could change the scenario. And I'll just give you one example. Like, for example, information business has evergreen sector all through. But then, you have the players keep changing. I mean, if you go back to the 80s and 90s, you had something called Yellow Pages, which everyone had to refer to. They disappeared, and you had a company called like Ask Me, which came in. But again, Ask Me could not go beyond telephone communication. Then you had something like Just Dial, which came in and innovated the whole space, managed the online information dissemination extremely well. But again, they couldn't progress from information dissemination to transaction well in time, and again was left behind. So clearly, you need to have companies being fleet-footed to keep changing, based on the change in the environment, which not too many people are able to do that. But then if you still want me to point out one sector, I think that could be telecom. Basically, because, it's again one of the basic necessities in life today. So, I normally say after air, food, clothing, and shelter, the next requirement is telecom for most of the population.
Yes. That's very interesting. Mr. Agarwal, you want to add anything on all-weather sectors? If
there
much debated. Yeah.
I agree with Devina. There are no all-weather sectors. Everything is a cycle. The duration of the cycle may differ. One can still find a few all-weather companies, but all-weather also with an expiry date. It could be 20 years, it could be 30 years, or it could be 10 years. But one can still find companies which can grow over a fairly long period of time for it to be confused as all-weather in perpetuity. But there's nothing called all-weather sectors. Each sectors go through up and down cycles. As Devina gave an example of Levers and Nestle and Bata, for about 10 years, they made no returns. And if you look at the history for 10 or 15 years prior to that, they seemed like all-weather and something that you should always buy and hold and never let go of. So that's a bit tricky. And again, since you're trying to find answers mostly for retail investors, something they could really invest in and sort of all-weather investing and just sleep peacefully. To that, my recommendation is very simple. The market has become far too complex at this point of time. It was perhaps a lot easier to find a few all-weather names or long cycle names, which could make you money over, let's say, 1 or 2 decades or 3 decades historically as compared to today, in a lot more dynamic world where disruptions come in from anywhere, from an absolutely unknown name, unknown startup can come in and put some spokes in your business model, which was a lot more difficult, let's say in the 90s or early part of the 2000s decade. And hence I would recommend that the retail investor should actually use more of experts to manage the money rather than trying to manage it themselves, and focus more on asset allocation decisions. And again, something which they're going to refer to. How much of your money should go into equities, how much debt, how much you can do high risk equity versus low risk equity, because each, you can find vehicles for both. You can do a little bit of sectoral thematic investing by finding in vehicles managed by institutional professional managers. For example, if you're really bullish pharmaceuticals for the next 2 years, you can buy one of the various pharma funds which exist as a part of your equity allocation. But that's also part of your asset allocation decision, more than a stock picking or a sector picking decision. I think that would be my recommendation.
Can I just add a bit, since Dheeraj spoke about thematic funds? I have a kind of anti-view, not on existing thematic funds, but on launch of thematic funds. I always think that that is, I mean, it is good for the fund house because it gathers AUM. But if you look at the track record, I mean, I again go by data of all thematic funds, whether it is a NASDAQ ETF, whether it is a pharma fund or an IT fund, they always come towards the peak of that cycle. When that thing has run for a while, the retail investor has this FOMO feeling that if I don't get onto this bandwagon, everybody is ahead of me. And then it comes at the wrong time. I mean, that's the data. I mean, in 2021, when all these NASDAQ ETFs were coming, I said everywhere that this is recency bias. So NASDAQ has done well for 3 years. You think it will do well forever? It will not. And 2022 was such a disaster. And then what happens is that after it is down 40%, then they panic and they will say that, should I get out now? And which is, I said, you're compounding a bad decision. You got in at the wrong time and now you want to get out at the wrong time. So since asset allocation determines most of your returns, if I leave that decision to the retail investor, then what value am I adding as a fund manager? You know, that is one of the key things which I am adding as a fund manager, whether it is in terms of geographies or sectors, as to where to be. And on just one other thing that came to my mind, which was what Amrish spoke about in FMCG and Reliance Retail. You know, this is a very interesting thing. You know, this is something I did more than 20 years ago. So it said like, if you look at Indian FMCG, and we said like, let's look at the Indian FMCG companies and let's look at their global parent. And we said these are branded companies with great brands. So where does this value of the brand show up? And what we found at that stage was that the global companies were making quite a good EBITDA margin, whereas the Indian companies had a far lower margin. But where their clout showed up was, you know, the distribution side, because many of the larger companies used to work on a negative working capital cycle. They would get cash in advance from the distribution system. So the brand was showing up there. The consumer didn't have the wherewithal to pay a higher price or give them a fatter margin, but that's where it was showing up. And that's the hypothesis we gave at that time, that it doesn't show up in the global companies because retail is more organized, because you have a Walmart or a Target or so on the other side. So that is, and as Indian retail will become more organized, you will see pressures on that side, because it's that Porter's model of where does the power lie? Is it with the seller? Is it with the buyer? Is it with the distributor? And now you see that power equation changing. Of course, over time, Indian companies, the EBITDA margins have expanded, but now you are seeing that power equation changing when retail is becoming organized, and therefore they have more bargaining power. They also have private brands or they buy out brands. So that's an interesting thing to watch over a period of time. And of course, you know, this because we have been following global companies now for almost 25 years. This is the other thing, that over time, the life cycle of companies has been reducing. If you look at the S&P itself, in the 1960s, the average age of the company was about 50 years. By 2015 itself, it was down to 18. Now I'm sure it must be even lower. Now, in the early 2000s, when we used to cover global stocks, the tech majors meant IBM, Dell, Motorola, Cisco. Right. You know, Cisco, I don't know how many people remember, was once upon a time the highest market cap company in the world. So those companies are still around, but that's not what you think of when you think of US tech or global tech.
Right.
So
not anymore.
That cycle is reducing. I mean, in India, it's not gotten so fast yet. I mean, it's not compressed as much yet. The companies that I had got bored of and they hence went global 20 years ago still remain the major, the Infosys and Bajaj Autos and so on. I mean, it will get a bit faster now in terms of the life cycle reducing. So that's the interesting thing, which is why one other statistic. Okay, I'm little into data. That we were talking of all-weather stocks. Now we did this exercise, which is a very simple exercise, which is that how many companies show profit growth every year? Not even 10% growth, 5% growth, just more than 0% every year for 10 years. So it doesn't seem like a big thing, right? So there were 4,200 companies listed 10 years ago. Guess how many of them had showed any profit growth every year? That's all. Profit growth greater than 0 every year. Can you guess how much those were? 10%. Only 17 companies out of 4,200 companies. If you go back 20 years, it's only 2 companies, HDFC Bank and Supreme Industries. That's it. That is it. So, all these Excel sheets are easy to make, DCF analysis, great to make. And every one of them, I mean, I can tell you 99% of them, unless the company is currently making a loss, will show profit growth every year out into eternity. And yet not even 5% of the companies meet that. So that is why it has to be dynamic and tactical asset allocation. We look at portfolios from scratch every quarter, that today, if I had cash, where will I be invested? It's another matter that from one quarter to the other, typically 85–90% of the stocks remain the same. But we keep that aside. We don't want to look at what we hold just now, because then, again, it will cloud your judgment.
Right.
So that's why investing is fun, because so many years later, there is still always something to learn.
Okay. So coming to the end of this session, thank you so much, all of you, for taking out your time and being a part of this exercise. I mean, it was a very insightful session for us, and it really helped us get a direction. And we really look forward to similar associations in the future. And right now, of course, we'll, the cover will come out with all these views and insights, and we hope to make a splash out of it.
Thank you very much. And bye, Amrish. Bye, Dheeraj.
Bye. Thank you.
Thank you, sir.
Bye. Thank you.